All right. Hello, everyone, and happy Thursday. We're going to go ahead and get right started. If you notice, I have a new little background that we just introduced into our Zoom, which is super cool. So we're going to go ahead and get started. So a huge shout out to Center for Rule of Affairs for being a great sponsor for the Grow Nebraska Foundation and for all the free monthly webinars that we can offer. The Center for Rule of Affairs is a 40-year-old national nonprofit organization based out of Lyons, Nebraska, and they strive to create vibrant rural communities, social and economic justice, environmental stewardship, and genuine opportunity for all while engaging people in decisions that affect the quality of their lives and the future of their communities. The center initially engaged decision makers through policy and continues to do so while also investing in small emerging businesses through REAP lending programs. So be sure to hop onto cfra.org and see what they can offer you and your business. And again, thank you to Center for Rule of Affairs for sponsoring. And our featured sponsor for this month is Wells Fargo Foundation. And our featured member is Rustic and Red LLC, and they joined Grow Nebraska in 2018. So if you're in the Cozad area, be sure to check out their little shop. They have apparel, some snacks, and some great gifts that you can share with family and friends. And then this week's presenter is Travis Stoker of First National Bank here in Kearney, and he actually helped me set up my retirement plan. So huge shout out to Travis. So I'm going to pass it over to him. And if you have any questions, be sure to pop them in the chat and he'll answer as he goes or at the end.
Awesome. Thank you, Zoe. I appreciate it. Get my screen shared here. Perfect. Well, welcome everybody. Thank you for joining the Grow Nebraska monthly educational seminar. And as Zoe said, my name is Travis Stecker. I work with First National Bank of Omaha, and I have been in the banking industry for about 14 years now. 6 of those I've been in wealth management. I hold my security licenses, and I currently cover the Buffalo County, Hall County areas in the state of Nebraska, but also hold my state licenses for the state of Colorado, Kansas, Iowa, Texas, Washington, and Wyoming is where I help and service clients. And typically what I do each and every day, I help families and businesses kind of navigate those tricky financial life events that take place. Today, I'm going to mainly focus on discussing how using retirement plans can help you as your business recruit and retain top talent. So to get into some details right now, it's, as you know, you're experiencing it every day. The labor market is extremely competitive. Just a few stats that I wanted to throw your way is it's even more competitive for those that are in the state of Nebraska. So Nebraska's unemployment rate right now is 2.1%. The national average is 3.6. The participation rate, which measures those that are 16 years of age and older that either have a job or are actively seeking a job, for the entire nation, that's right about 62.6% right now. And for the state of Nebraska, we're at 69.5%. So we have lower unemployment. We have a higher percentage of our population already working as it compares to the rest of the states. Benefit packages are becoming more and more important to business owners. I listed out here just a few things that we're seeing in some of our industries and businesses that we're working with as business owners continue to get more creative on what they want to focus on and what they want to offer to their talented employees. See things like student loan reimbursement, flexible PTO hours, the different health insurance and dental and vision packages. We're seeing a lot of life insurance being offered to their employees. fun things like, putting in gyms on site, snack and meal services, little coffee shops and restaurants that are being built inside businesses these days, profit sharing plans and retirement plans, and the list goes on. So with that, again, focus of my comments today, and really what I want to focus on is mainly simple IRA plans. So what is a simple IRA? This type of plan, it's a salary reduction retirement plan for certain businesses. This in a nutshell is a hybrid between the big 401k plans and a traditional IRA, an individual retirement account, traditional IRA. These, if you're self-employed or own a small business, these types of plans are perfect for you. Some of the requirements we'll get into here momentarily on what makes somebody eligible, what makes a different type of company eligible to participate. So as I mentioned, so who qualifies? Who's eligible for this type of plan? To qualify for it, you can't maintain any other employer-sponsored retirement plan. So that means you can't currently have, a 401k, a 403b if you're a nonprofit, a 457 if you're some type of government entity. You can't already be offering something like that to your employees and then start a simple IRA retirement plan. So that there is that restriction. And then really the second one is you have to be under 100 employees, 100 eligible employees. And the employees that are considered eligible, they need to have at least earned at least $5,000 in the calendar year in wages. So all in all, pretty simple. There's really those three main requirements to be eligible to offer a simple IRA retirement plan for your employees. So how does this benefit your business? A few things I have listed out here that I talk to business owners about a lot is helping, to retain and attract qualified employees. Again, as I mentioned earlier, with the labor market being so tight and aggressive and difficult to retain and recruit, having this in your back pocket to help attract top talent is incredibly important. A great opportunity for educating your employees. As business owners, I think it gets missed. It gets out of sight, out of mind. But one thing that I think about a lot is more financially fit your employees are, that equals less hardships in their life, which then then those hardships cause different distractions and time away from work. If you have a current retirement plan and you're not using your current financial advisor to educate your staff on the benefits of saving and updates in the tax code, any changes in like just economic updates, if you're not using those individuals to come on out at least once a year or sending your employees in, I really think you're missing a great opportunity to just provide that financial wellness to your employees and to your staff, help them grow, help them prepare for retirement. Think about just the lost time, the distractions, that really adds up to your businesses over time as these employees' minds are elsewhere. A lot of folks too, just to kind of go along with more on the education piece, where offering this plan, whether it's you as a business owner or the firm that you work with to offer this service, can add a lot of value. A lot of people a lot of folks don't understand how important the true impact of like tax deferred growth, compounding interest, and pre-tax contributions are. Most of these terms put people to sleep, frankly, but they are incredibly important to individuals help them fulfill some of their life wishes, their goals as they maybe aren't thinking about retirement today, but we all know it'll be here before we know it. One of the other ones that a lot of people kind of forget about or think that's involved in some of the retirement plans is, I have listed here, so no federal reporting. When you think of the big monster 401k plans, those have a lot of record keeping that goes involved. There's some IRS forms like the 5500 form that has to be filed each year. Simple IRAs do not have a lot of that administrative work and IRS oversight. And so that really helps free up and not bog down some of your administrative individuals with extra duties and extra time spent. So how does this help you as a business owner? So many business owners, put their revenue from their business back into the business and solely rely on that business becoming worth enough one day to sell and fund their retirement years. Business owners, when they start a business, they're so excited just to get their baby off the ground, and they're sinking all their money back into it and not really doing enough planning for the future on when I do stop working and I sell this business, how much money each month do I need in order to have the retirement, have the life that I hope to have one day. And so just hoping that the business is profitable enough and valued high enough to fund your lifestyle once you exit the business is frankly just not a good enough plan to have today. So offering a plan to your employees not only allows your employees to take advantage of, but also allows you as a business owner to opt into the plan and to start saving for yourself and for your own family and start putting money away. What a lot of business owners don't realize is that contribution to a retirement plan, that is an expense to the business line. So it would be, whether you're a sole proprietor, whether you're an LLC, whether you're an S corp, you are able to siphon funds out of the business through payroll that comes out non-taxable to you, because these are pre-tax contributions, and I'll get into some more of that here in some of my next slides. But this would be a pre-tax contribution, so there would be no Fed or state income withholding on those dollars, no Social Security or Medicare tax that's being withheld, and you're able to slide that out of the business, not pay business tax on it, count as an expense, and move it into an account in your name that is tax deferred and growing for retirement years down the road. So with the company match that you would be offering also, that would count as a business expense, and that would count, and be able to not or be able to avoid business tax on some of the profits that will be coming into the business. You're able to kind of share those profits with your employees, that way. The other thing I would highlight again is little to no cost when it comes to administration and management of the plan. And I'll go into more detail here on that here momentarily. So we've talked about how simple IRA plans are going to benefit your employees. We talked about how they benefit your business. We're going to spend the next handful of minutes talking about how this plan would work if you established one. So I wanted to remind everybody, so this any type of retirement plan is optional. Employees are not required to participate. They do not have to. They have the choice. So it is always optional. And with simple IRAs, the employer gets to set some of these requirements. They get to choose whether they're going to offer a pre-tax contribution up to 3%. So essentially a match. Those that are familiar with 401k plans or other type of retirement plans, you can offer up to a 3% match. There are some businesses that choose to offer a lower match. You can do 1%, you could do 2%, but the max that you could offer is up to 3% match. If you didn't want to match contributions like that, the other option that simple IRAs provide is doing a 2% of an annual salary that is just contributed once a year to the participants' simple IRA. So again, 2% annual salary given to them, or an up to 3% company match. And within that section would allow the participants to contribute up to the IRS limits, which are kind of my next couple numbers here. Each participant, each employee would be able to contribute. For 2023, the IRS has raised it to $15,500 a year. They would be able to put in, and if you're 50 years of older, you would get that $3,000 catch-up clause. So you'd be able to go up to $18,500 that you could be putting in a year. And just a reminder, those would be pre-tax contributions. Any money that you would put in would come off of your taxable income, bring down your taxable income, lower your tax bill. Would be how those contributions would work for you as the business owner and for any participants in the plan. One thing I wanted to touch on here in this section is cost. So when most businesses think of the 401k plans, they think of a lot of administrative cost, a lot of investment management cost. And that's just not the case with simple IRAs. With businesses, really their only out-of-pocket expense is going to be the match that they choose to do. And so if you said to yourself, "Hey, I'm halfway interested in this. What would be mine?" Just as an example, if your like monthly payroll was $10,000 in payroll for the month. You would take that times 3%. And so your out-of-pocket expense for the business would be $300 is what would be going to match those contributions. And again, that's assuming that every single person that you're paying is eligible for the plan, has opted into the plan, and it has their contribution at least at 3% to take advantage of the full match. So that would be worst case scenario. We know, and with my years of doing this, very rarely do I find 100% participation, which each business. And I find that either certain times in the year or with just certain individuals in their budgets, they simply just cannot do 3% or more all the time. Sometimes they end up lowering it, which would then lower the company match for that individual. Down to the 2 or 1 or whatever the participant set their contribution limit at. So outside of that is really the sole expense from the business side. Now, you're saying, well, there's got to be a cost somewhere, right? There's, how do people offer a plan like this? There is more. The participants are going to have the costs. So each participant pretty much pays their own way. So because you're able to invest how you choose inside the simple IRA plan, there is what we call an expense ratio inside each mutual fund that you can pick from. And so that cost ranges anywhere between 0.2% to 0.8%, depending on what type of fund each participant would choose to participate in, whether that was a really low risk mutual fund, very conservative, or it was middle of the road, or it was something really aggressive. Each participant gets to pick those options themselves, and those fees are all predicated on each participant. So the business is not responsible for picking that up. Each participant would have that cost that they would pay themselves. So kind of a continuation of how it works, just a few other items that I would want to highlight. As I was kind of alluding to earlier, each participant gets to choose how they invest in the account. For those of you that are more familiar with the 401k, some companies will dictate a vesting schedule. So you have to be with the company for so many years before you would get to walk away if you left the company with the company's money, with the match. With simple IRAs, you're immediately vested. And so if you had an employee leave after being there for 6 months, 1 year, all funds would go with those participants. They would be entitled to all the funds that are vested immediately. Also talking about like any separation of employees and what that meant. Typically, if you're participating in a simple IRA plan and you left that employer, you would no longer be able to contribute to the simple IRA. Most individuals would then either, if their new job had a simple IRA plan, they could transfer it there, or if they again had the simple IRA and the new company did not offer a retirement plan, they could transfer it to a traditional IRA, another pre-taxed IRA tool that the IRS gives to us to take that money with them, essentially take it out of the company plan, move it to a traditional IRA, and then they'd be able to contribute to it going forward if they chose to. With simple IRAs, there's no loans. You can't take loans against each of the participants wouldn't be able to take loans against those accounts like that can be offered in 401k plans. There's also currently no Roth options available. All simple IRAs would only be a pre-tax bucket of money to contribute to. There would be no Roth or post-tax options available. One nice thing about, for you as a business owner, let's say you're a business owner that pays themselves a pretty high salary, high income earner, there are no income limits to participate or be eligible in a simple IRA plan, which is a really nice benefit. Because for an example, for a joint filing family, if their taxable income in 2023 is above right around the 150,000 mark, you're not able to contribute to, you're not able to get a tax deduction for your IRA contributions. And so it really doesn't make sense for you to contribute there if you don't get the tax deduction. For Roth IRA contributions, if you as a family, again, as a joint filer, if your income is above 230,000, you can't contribute to Roth IRAs either. So you start losing different options to contribute to, and so having a no income limit available to you in simple IRAs allows you and your family to put money away no matter where your income level is, or if that were to change from year to year, allows you to be eligible. We have a question that came in on the chat that I want to address. It's like the question is, in a simple IRA, can you split up your percentages to different accounts, or do you have to stick with just one? So I want to clarify, when you say accounts, I think you're probably referring to different investment strategies. different mutual funds. So if I'm right about that, if you would just type in the chat, yes, that's what you're referring to. I want to make sure I get the question right. But perfect. Yep, they said yes. So yes, you can. So there's probably typically 50 or so different mutual funds that are going to be available to each participant inside one of these plans. Again, like I mentioned earlier, ranging from really, really conservative to middle of the road, all the way to aggressive. And as balances start to grow and you start to add more money, it typically makes sense for individuals to start diversifying a bit, and you can have 25% of your contribution go in this fund, 25 go here, 25 there, and 25 go there. You can split it up however you want. Yep, definitely possible. Thank you for the question. And again, just a reminder, if anybody else has any questions, we're monitoring the chat, so please feel free to type those in there, and we'll get those addressed as we go. So a few other things to point out when we're talking about how the plan works that you might be offering. So we talked about the income limits and how important those are for individuals, just having a tool to save for their retirement. The other thing to be aware of would be very similar to traditional IRAs, those pre-tax buckets. If you were to withdraw before the age of 59 and a half, the IRS charges a 10% penalty. If you were to take out money, again, if you're younger than 59 and a half, there's that 10% penalty. And then your withdrawals would be, you'd have to claim them as income for federal income tax and for state income tax. So for an example, if you made $50,000 in the year and you decided that you needed an extra 10,000 and you took it out of your simple IRA plan, you'd pay a 10% penalty on that money, and you'd claim that 10,000 as income. So now it looks like instead of making $50,000 in the year, now it looks like you made $60,000 in the year that you would pay income tax on. So typically when I am advising the participants and we're opening these types of accounts, I'm typically talking to them about their emergency savings fund, making sure that that is adequately funded. And then any money that's being directed into these types of accounts, this is money that they can live without and not typically need to tap into for a very long time with that retirement focus. There's no sense wasting 10% to the IRS if you don't need to. So for those that might be interested or starting to plan, for those that are starting to look into things further, I wanted to give just a little bit of a update on what how to get started and what to look for. So there's this IRS form. It's the 5304 simple IRS form. You could Google it right now. You could pull it up and see it. It is essentially it's the plan document. It's what governs the plan. And there's a bunch of blanks to fill in that you can customize yourself, and then there's some rules that you just can't change. And so that is what every plan the business owner and plan administrator would create and set up. And again, those are pre-fillable IRS forms already. Typically, if you're looking for an investment advisor that's going to help you with the plan, we're going to be the ones to get that document for you and help you fill it out. But that's going to be your document that you keep in in your office manager's office, or your HR manager is going to have that document and help ensure that the plan is sticking to that document and the rules listed in it. So that document's really, really important. Also, I would encourage you to find someone like myself that's going to help hold your hand through it, educate your employees. As I talked about before, if you're not utilizing those of us in our industry for just the education and financial wellness for yourself and for your employees, I think there's a miss there, and I think there's a lot of value that could be added that would help your businesses grow and just have more financially fit employees, which then is going to help your businesses in the long run. So each participant would need to enroll themselves. They would fill out their own individual paperwork. And then talking about onboarding a payroll provider. So depending on how you currently do payroll, whether it's through QuickBooks or Quicken, or you have a third party do it for you, or whether it's your CPA firm, it doesn't matter. That's something that someone like myself would help facilitate. And I'll spend just a couple minutes on this topic before I wrap things up and take any last questions. But the payroll provider, what typically happens to it, I would say that would be maybe the only other cost that a business could incur, is if you were adding this extra duty to your payroll provider, or to do the withholding for the retirement plan. But in all honesty, adding one column in your QuickBooks or to the payroll provider software program that has withholding, and having the program just calculate that for it, is not very time sensitive, and shouldn't really add much cost at all. But one thing that I do, I reach out to that payroll provider, talk them through the site that they need to log into, do demos with them so that they understand how to do the withholding, and how that money can then be electronically transferred to each of the participants' accounts. And so we help kind of facilitate that for each of the payroll providers, no matter, again, whether you have somebody in-house, whether you outsource it, it doesn't matter. It can be accommodated, whichever option you're paying for and that you prefer. So with that, I know that was a lot of information in a short period of time. I have my contact information here. If you have questions or want to reach out, I'm available. We do have a question that came in the chat that I will look at here and see. It says, does the simple IRA take a lot of time to administer and set up? So no, I would say that as a business owner, setting one up, doing the enrollment paperwork, very, very quick. The application is three to 4 pages for the business owner to fill out. Now, if the business owner is doing payroll themselves, that would add just one little extra job duty to their plate. But after it's set up, there's nothing else that they need to touch. I would say, though, that where some business owners maybe should spend more time is being an advocate for the plans. I think some business owners really like what it's doing for their employees and offering it, but then over time, sometimes it's set up on cruise control, and then they start to not talk about it with their employees during benefit enrollment. And so, as we talked about earlier, when the labor market is so competitive like it is now, if you're not, as a business owner, if you're not touting your benefits package and helping your employees fully understand the importance and what like the true value of the benefits you're offering are, then I think, again, you're asking for people to potentially leave and not really understand the good. They might think the grass is greener on the other side, but they don't really understand how good they have it with certain benefit packages that you're already offering. So I think taking time to be an advocate for a business owner, definitely could take up a little bit of time, but just administering the plan and setting it up, very simple. Another question that has come in: what if my business would grow beyond 100 employees after a few years? What would I need to do? Great question. So the IRS, if you go past the 100 employee mark, you get 2 years to either be back under 100 employees or close the plan. And when I say close the plan, I don't mean not offer benefits anymore. Typically at that point, if you're that big, we're probably starting to have the conversation. Does it make sense for you to go from a simple IRA to a 401k plan, to go after the bigger type plans that you can customize more things with, offer more customization, more bells and whistles, more things that you can't do in a 401k plan if you're ready to make that move. But the IRS gives you two calendar years to fall in accordance with that rule. It's a great question though. And that's something that I would be watching, or any of the financial advisor that you're working with should be monitoring that, talking to you about it, and making you aware of it. I wouldn't put that burden on the business owner. That's something that an investment management individual should be keeping up on for you. Any other questions or thoughts before we turn the time back over to Zoe and wrap up things as it pertains to a tight labor market, anything economic related, benefits that our businesses are offering, simple IRA plan specifics? Okay, well, I don't, actually, there's another comment or question that come in. If we don't have a local advisor, can you meet remote? Yes. So just like our technology, like we're using today, I think we have people spread wide and far, hundreds and hundreds of miles all the way across, the state of Nebraska and potentially even other states. And so can one of these be established and worked remotely? Definitely. As I mentioned earlier, I'm licensed in about 7 or 8 different states. Whichever financial advisor you choose to work with, those individuals need to be licensed in the state that they're working with those people in, wherever their physical address is. But doing things remote these days is just kind of something we learned how to be really good at since the pandemic, and so that is definitely something that can be accommodated and done. So with that, I will thank you all for your guys' time and your attention and the questions. Actually, one more question has come in. Can you change your investment in the simple IRA to a different mutual fund later on? Yes, you certainly can. You can change your investment election anytime you want. And because it's an IRA, there's no fee, there's no capital gain tax, there's nothing like that. You could change your investment strategy 100 times in the year and not have a penalty or not have a tax come up at all. The other thing I would say too is with a simple IRA plan, you can change your contribution limit multiple times throughout the year too, just so you don't make the payroll provider mad by changing it too often. There's no rule in the plan. If you want to go from 1% to 3% to 10% and back down, you can move your withholding percentage around multiple times in the year without any kind of penalty or problem. I typically find people coming into Christmas season lower their contributions a bit, free up some cash flow, and then once Christmas is paid for, January, February, sometimes March, that's when contributions go back up and then they start to fund their retirement plan again. Well, great questions. Thank you all for your time and attention. Zoe, I will turn things back to you.
All right. Well, thank you, Travis, for taking time out of your day to present. Like I said, Travis helped me with my retirement plan, so I highly recommend reaching out to First National Bank if you're looking to get those set up for your team. So again, thank you, Travis, and thank you to everyone that attended live. And if you're watching the recording, we missed you live and in stereo, but we're so happy that you're watching the recording. Oh, Tanya says, thank you for that great info. If you have any questions, please feel free to contact me at zoe@grownebraska.org, or you can easily give our store a phone call and any of our team members would be happy to assist you or answer any questions that you may have. Also, if you're interested in presenting for a Grow Nebraska training, please reach out to me. We are looking for presenters, so I'd love to chat with you. Our upcoming training, we have one on May 25th, which Alyssa Ryan is the presenter. She's a social media expert. So if you're ever struggling with Facebook ads or don't know where to start with them, we highly recommend that you get registered for that one. And then on June 7th, we'll have Maria Elena Duran back again to cover and teach you how to learn the basics of Google Ads. Sorry, I cannot speak today. But both of those are live on the grownebraska.org website, and they are just under upcoming trainings, and you can get registered for them early, and then you won't have to think about it down the road, and you will get reminder emails. So maybe after this, just hop on over to our website and get registered for those. And then let us know how the Grow Nebraska Foundation is doing. We would love your support on our Google reviews, so feel free to scan this QR code, or you can easily do a Google search and just search Grow Nebraska, and there you can leave a Google review. We would greatly appreciate it. And that's all my announcements for today. So again, thank you everyone, and thank you, Travis, for presenting, and I hope you all have a great rest of your week.